All right, here we are, Ron the tax guy from Texas. Listen, we're at the end of the year now, and if you haven't watched my end of year tax strategies, you got to watch it, because come January 1st, you cannot implement some of these tax saving strategies that I mentioned on my other videos. So please pay attention. Please be ready to implement those tax saving strategies. So if you haven't also signed up for my weekly newsletters, I send out tax tips every week on a Friday. It comes right to your email, and I have tax advice and strategies and issues in my newsletters, and I have them archived on my website. So you're missing out on a lot of information. And now, what, 9 days, 10 days from the end of 2020, that's not a lot of time, but you still have time to implement some of the strategies. I'm going to go over them with you right now. It's December 21st. Any questions, feel free to email me, or Ron B, RONB, at rpbfinance.com. I'll have it on the screen, so don't worry if you don't remember it. Okay, and that's my website, rpbfinance.com. Okay, so let me switch the screen here. I want to pull up my newsletter, which you could all be having if you are already subscribed, but that's okay. I'm going to go over some of those things right now. So at the end of the year, there are a number of things to consider that may have a positive impact on your tax obligation. Now I'm going to go through a list of 15 ideas that may be worth a quick review. Number 1, make last-minute charitable donations. Caveat with that, the IRS has increased the standard deduction. So on the itemized deduction schedule, Schedule A, where you list your medical health-related costs, which has to exceed 7.5% of your adjusted gross income, your sales tax deduction, your property tax deduction, your mortgage interest, your charitable donations, all go on one form, and they have to total over the standard deduction in order for it to help you. Now, if you've been used to doing that since the tax law change in 2018, then go ahead and make charitable donations now before the end of the year. It has to be done before the 31st. So if you write out a check and the charity says they received it January 2nd, and that's when they credit your donation for, it won't count. So make sure you're making those donations before the end of the year and that they're credited for the year 2020. Or if you're watching this in subsequent years, whatever year is about to end, you want to make it for that year, not the following year. Make sure it's into your account as a donation as of the year in question, not the following year, by December 31st. Okay? And that holds true for other kinds of taxes that you're going to pay, like property tax. So many times I see my clients, they'll bring in a property tax statement. Hey, this is a what I paid for taxes last year, and I look on it, they wrote and very wisely they wrote the check number and the date. Well, the date happens to fall on January instead of December or any previous months before December. So they won't get credit for it. Even though you were billed in the previous year, but you paid it in the following year, you have to wait till the next tax season before you can take that tax deduction. Anyway, the other idea is if you're going to give to a church or other nonprofit and you're very disciplined about how much you give, etc., think about doubling it. If you can afford to double the donation, what you were going to donate for the following year doesn't have to be the full amount, maybe in half or whatever partial amount. Just give more before the year ends, so it counts for this year. All right, and remember there's a 15,000 annual gift limit. You can stand out in the corner of the street and hand out $15,000, up to $15,000 to everybody that passes by, and you have no tax consequence. Okay? Now, do I recommend you do that? Of course not. What are you going to do? You're going to give away to your loved ones that are responsible, hopefully. You can gift up to $15,000. Why do people do that? To reduce their taxable estate. Okay? It does nothing for you on your tax return, but if you're trying to reduce your estate, then and avoid what we call death taxes when you pass away, then think about giving money to your loved ones or people you want to give money to right now. And listen to my videos. Again, there's so much information. You got to listen to my other videos that talk about charitable remainder trust, charitable gift annuity. Okay? I'm not going to get into it now because it's on the other video, so please, I've given you a lot of information. You just have to be willing to watch the videos and then implement the strategies. Also, your investment portfolio. You're allowed to deduct $3,000 in capital net losses, net capital losses every year. So let's say you had a $20,000 loss in your investment portfolio. Well, you're allowed to deduct $3,000 a year of that each year until that $20,000 is used up. Okay, so let's say you have investments that are doing bad, especially through this COVID time period and also the previous year. Okay, so the market's been dropping and your portfolio hasn't recovered yet. Okay, you're allowed $3,000, right? For a loss per year. Okay, so you don't have to take a $20,000 loss if you don't want to take it now, but maybe you can take something that exceeds $3,000, and it has to net $3,000 because and if you have gains, those losses are going to offset the gains. So keep all that in mind. But let's say you have no gains. Let's just make it simple. You have no gains, and you want to have a tax benefit from that investment loss that your portfolio is experiencing now. Well, okay, sell off enough of your losses to claim on your tax return, but you got to do it before December 31st. Okay, and if you have gains, fine, sell off losses, sell off the losing parts of your portfolio, and those losses will offset the gains. Remember, you're taxed on the gains. I had a client last year who got surprised by a huge tax bill. I mean, a huge tax bill on his investment portfolio. Is it great that he made a profit in his investments? Yes, but he didn't prepare for the tax that he would have to pay on that capital gain. That profit is called a capital gain, and you have a capital gains tax. Okay, so if you're anticipating gains to be reported on your 1099 that you're going to receive from your brokerage firm, then you might want to get a hold of your broker, your financial advisor, and say, hey, sell off these bad ones, because then I can use it to offset my gains. And what does that do? It'll either eliminate all those gains and you have no tax to pay on your profit, or you'll reduce the profit by those losses and you'll have lower tax to pay. Okay, let's move on. You can maximize the kiddie tax threshold rules. $2,200 of unearned income taxed at your child's lower tax rate. They used to use this strategy in the past before. Not many people take advantage of that, but you should. Up to $2,200 of unearned income you can tax at your child's lower tax rate. It has to be something not in your name. These are portfolios, investments that are passive income. That's why it says unearned income, that you can take off on your taxes by using the, not take off, it's not a deduction, it's you get charged at a lower tax rate, okay, at your child's tax rate. So maximize the kiddie tax threshold of $2,200 or less of unearned income of your child. Also, one of my big pet peeves is the 401k, your 403b, your thrift savings plan, whatever pre-tax retirement savings plans you have at work. By December 31st, maximize it. Now, you might say, hey, Ron, I can maximize it. I need that money to live on. But think about what you're saying. You're saying, I have money to pay the IRS, but I don't have money to pay myself. That's what you're saying. Because what does your contribution to that pre-tax retirement plan at work do for you? It lowers your taxable income. The tax is deferred until your retirement years. Okay? So please use that strategy and maximize your contribution. I know that you need money to live off of, but remember that money you're not putting away in your retirement account is money you're being taxed on. So you're in essence saying, not dollar for dollar, but what in essence you're saying is, I don't have money to pay myself, but I have money to pay the IRS. Think about that logic, okay? And then make a decision to fund your retirement account up to the limit by the end of this year. So you got to get to your HR people who have your retirement plans and tell them, hey, I want to make an additional contribution before the year ends. Okay, also if you're going to get bonus checks from your employer, ask your employer to issue you that check after December 31st. Why? Because then you won't be taxed on it for this year. You'll be taxed on it almost a year and 3.5 months later. So you're just putting off getting paying the tax on that bonus check. So think about that as a tax strategy. Put that off. Also, if you have health savings accounts or dependent care accounts, remember some of these expire if you don't use the money in there that you put in pre-tax. It will expire. It doesn't roll over. And then the managers of those accounts will issue you a check. It'll be dispersed to you, or it'll sit in your account as not being tax favored. So use the money out of that account for qualified medical expenses, so you don't lose the money. It's a use it or lose it proposition with the health savings accounts and the dependent care accounts. So use it, but do it before December 31st. Okay, as far as the COVID related PPP loan that came out and the EIDL loan that came out this year for small business owners, I'm sorry to say that the tax regulation on that is not in stone. And I've been suggesting and recommending and advising my clients, my business clients that got those loans, hey, don't panic, but we have to wait sometimes till January because Congress meets and makes tax law changes at the last minute. So I'm sorry, I can't give you better news other than you got to wait till around January to see how your loans are going to be taxed. Also, the PPP loan had a for forgiveness part of that, forgiveness provision. Make sure you've got your paperwork and the form filled out to get your forgiveness on your PPP loan. Okay? If you're going to do any qualified rollovers from a retirement plan that you have at work and now you've stopped working, you've left the business, the job, the employer, you can roll over your retirement savings account into another retirement savings account like a Roth IRA or a traditional IRA. But make sure that rollover is dollar for dollar. In other words, the entire amount should be rolled over to the new account. Make sure it's an institution to institution transfer and that money doesn't touch your hands. Okay, that is the safest way to do it. Whatever new brokerage firm that you're going to open your IRA with, then have them do the forms to transfer it over. Is there a tax benefit for doing it before the end of the year? No, but I'm just reminding you to get that done. Also, start to begin to organize your tax records and look out for new 1099s. Some new 1099s came into existence since the tax law change in 2018. So be prepared for possibly new 1099s coming your way in after the year ends. Okay, that's it for now. If you have any questions, email me. Go to my website, sign up for my tax letters. There's what I just went over is in my tax letter that I send out to my clients every week. So if you've missed the information or I went too fast, go to my website, rpbfinance.com, and look up the archived newsletters, and you'll be able to read it for yourself. Okay, thanks for being with me. Happy New Year to everybody. Happy holidays. Don't put off these tax strategies. I know there's a lot of parties going on and whatnot, but these are things that are going to help you tax-wise. Okay, so don't put it off. Get the party mindset out of your head. Just set it aside for a little while and get these tax things done first. Okay, because there's only 10 days left as of this recording. Alright, bye for now. Thanks for watching. Appreciate it. Appreciate you. Bye-bye.